Hello and welcome to the Expert Exchange. Alpha Ba joins me today. He is the Chief Investment Officer at Pillow Investment Partner, a global investment firm focused on long-term opportunities across markets. Just days into 2026, the world is already facing its first major geopolitical shock. The United States has removed Venezuela's president, Nicolas Maduro, an event that goes far beyond politics and straight into global markets. With Alpha Ba's global investment perspective, we're looking past the headlines to examine the longer-term market consequences and what this moment means for global investors. Alpha, thanks so much for being here.
Thank you for having me, and Happy New Year, everyone.
Now, from a geopolitical standpoint, how significant would the removal of President Maduro be for Latin America and for U.S. influence in the region?
So I think geopolitical developments generally, from a market standpoint, are just a look through. They don't impact the market one way or the other over the long term. However, the 1973 oil crisis did. Apart from that, no geopolitical crisis, wars, or anything else impacted markets since the Second World War. On this one here, the U.S. hopes certainly that this rendition of the president of Venezuela will lead to a realignment of Latin America in favor of the U.S. That's the hope. I'm not sure that's the right strategy, but that's certainly their hope from a U.S. standpoint.
How might global markets initially price in such an event? Would this be viewed as a risk-on or risk-off shock?
I think looking at it from just a risk-on or a risk-off is too narrow. I think we've seen the market over the past 2 days actually go up, so it's not necessarily a market. It hasn't been a market moving event in the short term, and I don't think it will be in the short term. Because at the end of the day, Venezuela only represents 1% of global oil production, about 1 million barrels a day. To get that to where they were 25 years ago, which is 3.5 million barrels a day, you need a lot more infrastructure. So only when those investment in infrastructure start happening, will the market actually price that in. What the market is grappling with, and we know the market's not very good at pricing in geopolitical risk, but what the market is grappling in right now is what is next. So is Trump going to go after Greenland, which might as well dissolve NATO? So that has implications for Europe. Will the U.S. administration go after Cuba, which is rather insignificant, or Mexico, which is significant from a supply chain perspective into the U.S., or Colombia, which would be significant from the drug perspective? So we don't know yet where the next dominoes might fall. So the market chooses, I think, wisely to ignore it.
What kind of reaction would you expect from major global players such as China, Russia, and Iran? And how could that influence global capital flows?
Yeah, I think it's the way things are going right now. It looks like the U.S. is on a strategy to divide the world into zones of influence or spheres of influence. I think number one is the U.S. is unwinding its own global order. That is rather clear since Trump's been in power. Dividing the world in three spheres of influence will portend that the U.S. dominates the Western Hemisphere, certainly the northern part of the Western Hemisphere and Latin America. China would dominate Asia, and then Russia would dominate Europe. Now, if that were to happen, there would be two developments. China is actually happy to dominate Asia because Asia is growing at 4%, which is double the North American rate. So it's actually better to dominate a growing region, right? So from China perspective, they would be happy with that. And then number two, from a kind of macro perspective, even if there are three respective spheres of influence, they will still have to work together on certain things. They have to trade together. They have to work together. So absent a robust international rule of law mechanism, that will create friction. So we think that defense investment will continue to grow. And obviously AI is very important. And AI, in our view, it has been our long-standing view that AI generates productivity both for the US and China, because those economies are the ones deploying AI the most. And so if you look at AI, the infrastructure being built through data centers needs energy. And we think that China is achieving energy dominance relative to the US. If you look at the power grid of China, it's about double that of the US. 3.75 terawatt is what China has. And within that, a third of that is renewables. And so, and as well, ultra high voltage, the ultra high voltage infrastructure in China is growing at 80 times the rate of the US. And so, power is really critical for data centers. And China has abundant power and cheaper power than the US. Frankly, if this US development is around achieving oil dominance, then I think the US is really barking the wrong tree here. The world is going towards renewables. You can slow it down a bit, but you can't, I think, reverse that. So the US is going after a resource which is oil, which is almost at peak demand in the next, I don't know, 5-7 years kind of thing. 20 years from now, we're not going to be using artificial oil. The IEA says that 32% right now of energy mix globally is oil. Is renewable, and that 32 is going to 45. So the direction of travel is towards renewable, not oil, even though oil could help in the short to medium term here.
Could this set a broader precedent that investors need to factor into geopolitical risk pricing elsewhere?
Yeah, so as I mentioned, geopolitical crises generally are not a problem for the market over the long term. They sometimes attract a violent adjustment, but the adjustment is really short term. So it's hard to really see this development as a harbinger of a market moving event going forward. I think what's happening is that the international rule-based system is fraying of the seams, and so what that portends is that volatility should rise. Yes, but I think it's just one more element rather than changing fundamentally how things are done. And we're not sure. We're not sure the U.S. is going to go after Greenland, potentially after Canada. We don't know. I mean, this is speculative. If they were to go after these countries, and as well if they were to expand this strategy outside North America, then I think that would be much more of a market moving event.
And Venezuela holds some of the world's largest oil reserves. In a political article, Trump is quoted as saying U.S. companies are going to have to go in and spend billions of dollars to fix the badly broken infrastructure. What are some of the implications for Venezuela's potential re-entry into the global oil markets?
Yeah, I think we need to get today. Venezuela produces about 1 million barrels a day, which is 1% of global markets, and the global market is pretty well balanced right now in terms of supply and demand. If Venezuela were to get to a place where they produced 3 or 4 million barrels as they used to 25 years ago, number one, that would require huge amounts of investment, and the huge amount of investments follow certainty. So the U.S. will have to provide a certain legal framework for American companies to invest. That's step one. Step two, once they achieve higher oil prices, we have to assume that they don't achieve the higher oil price, the higher oil production from Venezuela after demand has peaked. As I mentioned, demand is supposed to peak in the next 5 to 7 years. So if you achieve that before, then you get a price appreciation from a Venezuelan perspective. If you achieve that after, then you might actually get prices to go lower, because if demand slows down and supply goes up, that generally means lower prices. And let's not forget, from a political standpoint, in the U.S., presidents want lower inflation. And one way to achieve lower inflation is through lower oil prices. And so you can't, want lower oil prices at the same time as wanting higher production for Venezuela, because, it's kind of a reflexive argument where higher production begets lower prices and so on. So lower prices would not be incentivizing companies to move into Venezuela to invest in their infrastructure. But be that as it may, the U.S. administration does want higher production from Venezuela. So that is a risk for Canada, because the Venezuelan production competes against Canadian production, because both are heavy crude, which are refinable in the U.S. Gulf Coast and in the U.S. West Coast. One important development, though, is that the U.S. strategy might also want to block China's rising influence in Latin America. So to that extent, this is a very significant potential development. China has been investing in Latin America. As we know, 80% of Venezuelan oil goes to China, but that only represents 5% of China's oil imports. So China can find alternatives, but they were definitely looking to increase influence in Latin America, which is the backyard of the U.S. So this might be the U.S. fighting back.
Now, just on a general note, could this event shift investor appetite toward or away the emerging markets as a whole?
Yeah, I think that's an interesting development. So if you look at last year, maybe I'll answer the question broader than just emerging markets. Let's look at the world, U.S. versus non-U.S. So last year, the U.S. markets were up about 18%. The non-U.S. market were up 33%, almost double. And the long story short is that right now, U.S. rule of law is deteriorating both domestically and internationally in terms of the rule-based system. So all else equal, that should reduce multiples in the U.S. at the margin. These are marginal developments, but they're important because markets price at the margin. So lower multiples should be assigned to U.S. companies, relatively speaking. And right now, if you look at the world, what seems to be happening is that the EPS growth gap in the next couple of years, 2-3 years, because we look long term. So the growth gap in terms of EPS between U.S. and non-U.S. has closed. Yet the valuation gap has not. So the U.S. trades at 23 times earnings. The rest of the world trades at about 14 times earnings. So the U.S. sits at a 50% premium to the rest of the world with not much better EPS growth. What the U.S. has going for it is a much higher return on equity. So this better capital efficiency favoring the U.S. does portend or does justify a higher multiple, but maybe not a 50 or 60% higher multiple. Maybe the multiple should be 50% or 40% higher than the world and not 70% as it is now. So there could be a multiple contraction in the U.S. So the outperformance that we saw last year in terms of non-U.S. versus U.S. could actually continue. It is by no means certain that the U.S. should outperform the world. But at the same time, as I said, the U.S. has much higher ROE, so it's still a very attractive destination for capital. We're not saying that the U.S. would be starved of capital. I'm just saying that at the margin, there should be some capital deviating from the U.S. into non-U.S. assets, including gold. Gold was up 60%, 62% last year. So gold is interesting. The dollar was down last year 10%. So these developments could actually be a harbinger of things to come.
All right. Well, thank you so much, Alpha. It's Alpha Ba. He is the Chief Investment Officer at Pillow Investment Partner. Always a pleasure. Thank you so much for your insight, your perspective. Much appreciated. Thank you so much.
You're most welcome. Thank you.